Picture this. You're standing in your childhood kitchen, except it doesn't feel like home anymore. It feels like the world's saddest filing cabinet. Stacks of unopened mail, 3 different bank statements from banks you didn't even know your dad used, a login screen for an account nobody can get into, and taped to the fridge a sticky note that just says, "Ask John about the thing." Nobody knows what the thing is. And in about 6 weeks, you're going to find out that the thing is the difference between your family getting an inheritance in 2 months or fighting about it for the next 2 years. My name is Nico, and today we're going to talk about the one financial document that almost nobody wants to think about, but that quietly decides whether the worst week of your family's life also turns into the worst year of their financial life. We're going to break down exactly what happens legally and financially when someone dies without a plan, what it actually costs in real dollars, and why the people who say, "I don't have enough to worry about this," are usually the ones that hits the hardest. This is one of those videos that's a little uncomfortable for about 30 seconds and then genuinely useful for the rest of your life. So if that sounds like your thing, subscribing helps a ton, and a thumbs up tells me to keep making more of these honest breakdowns. Okay, let's get into it. Here's where we have to start, because the numbers are honestly kind of shocking. According to Northwestern Mutual's 2025 Planning and Progress Study, 61% of Americans, that's roughly 6 out of every 10 people, do not have a will, not a trust, not some elaborate estate plan, a basic one-page will. And here's the part that hits close to home for a lot of people watching this. That same study found nearly 2/3 of Gen X, the generation currently watching their own parents' age and starting to think hard about their own kids' future, still don't have one either. Trust and Will's 2025 report backs this up from another angle. 55% of Americans have no estate plan whatsoever, and only 36% of parents with minor kids have a will. Read that last one again. That means roughly 2 out of every 2 parents of young children have never legally written down who should raise those kids if something happens to both parents.
So what actually happens if you die without any of this in place? Every state has what's called intestate succession law, basically a default inheritance formula that kicks in automatically whether you wanted it to or not. It sounds simple. The state decides, but in practice, what it means is a process called probate. Probate is the court process that identifies your assets, pays off your debts, and legally transfers what's left to your heirs. And across multiple sources, probate typically costs somewhere between 3 and 7% of the total estate's value, and takes anywhere from 9 to 18 months for an average estate, 2 years or more if anything gets contested. And intestate succession doesn't always do what people assume either. In a lot of states, if you're married with kids, your spouse doesn't automatically inherit everything. Depending on the state, they might get the first chunk of the estate plus half of whatever's left, while your kids, even if they're minors, get legal claims to the rest, with a court controlling that money until they're 18. Most people find out about that for the first time from a stranger across a desk at the worst possible moment. 3 to 7% might not sound like much on its own, but here's where it gets really interesting. That percentage doesn't care whether your estate is big. It applies the same way whether you're a multimillionaire or a regular person with a paid-off house and a retirement account left over from 3 jobs ago. And for almost everyone watching this video, that second description is a lot closer to home than the first. Let me show you the math using a guy I'll call Derek. Derek's 38. Lives just outside Columbus, and last year his dad, I'll call him Big Mike, died suddenly of a heart attack at 67. Mike was divorced, retired a few years back, and owned his house free and clear. Nothing dramatic, no big debts, just a normal, decent life. Except Mike never got around to writing a will. He always said he'd deal with it eventually. Eventually never came. Here's what Derek walked into. The house, worth about $280,000, couldn't be sold, refinanced, or even have the utilities transferred until it cleared probate. In Derek's state, that took 14 months. 14 months of an empty house just sitting there while Derek and his 2 siblings covered the property taxes, insurance, and utilities out of their own pockets, about $1,100 a month for over a year. That's already more than $15,000 in carrying costs before a single dollar of inheritance shows up.
Then there's the savings account, about $40,000, frozen the moment Mike passed. Derek had to put the funeral on a credit card because the cash sitting right there, his own father's money, was legally untouchable. And here's the part that will blow your mind. Mike also had an old 401k from a job he'd left almost 20 years earlier, worth around $65,000. Want to guess who was still listed as the beneficiary? Derek's mom, Mike's ex-wife, the woman he divorced 2 decades ago and barely spoke to since. Beneficiary designations actually skip probate entirely, which sounds like a good thing, except in this case it meant that $65,000 went directly, immediately, and legally to an ex-spouse who'd remarried and moved to Florida, completely bypassing Derek and his siblings. Nobody did anything wrong. Nobody was being sneaky. It was just a form that takes 10 minutes to update and never got updated for 20 years. By the time the dust settled, Derek's family had paid roughly $22,000 in attorney fees, court costs, and executor expenses just to legally untangle a fairly simple estate, on top of losing that $65,000 to an ex-spouse nobody had spoken to in years, on top of 14 months of carrying costs on an empty house. Out of what should have been close to a $385,000 inheritance, the family ended up almost $90,000 short and more than a year later than they should have, with grief stacked on top of paperwork, stacked on top of family tension about who's handling things. That's the math is brutal part of this video, and we're not even close to done.
Now here's the part I think is actually the most hopeful part of this whole video, because 2 years later, something almost identical happened to a couple I'll call Priya and Jordan, and the outcome could not have been more different. Jordan's mom passed away unexpectedly. Similar setup, a paid-off condo worth around $150,000, a retirement account, some savings. But about 3 years earlier, partly because Derek had watched Derek go through his nightmare, Jordan's mom had spent one afternoon with an online estate planning service. Total cost about $450. She wrote a simple will, updated every single beneficiary form, and put the condo into something called a transfer on death deed, which lets real estate pass directly to a named person, completely skipping probate. When she passed, here's what happened. The retirement account and savings transferred to Jordan in about 3 weeks, just a death certificate and some paperwork. The condo transferred through that deed in about 6 weeks with a filing fee under $200. No probate court, no frozen accounts, no 14-month wait. Same size estate as Derek's family, similar family situation. Total cost from start to finish, the original $450 plus around $200 in filing fees, about $650 total. That's it. The entire difference between Derek's 14-month $22,000 nightmare and Jordan's 6-week $650 transition came down to one afternoon years earlier when nobody was even thinking about death. So why does almost everyone end up more like Derek's dad than like Jordan's mother-in-law? It's not because people don't love their families. It's psychology.
Thinking about your own death triggers something psychologists call mortality salience. Basically, your brain treats "make a plan when I die" the same way it treats "think about being eaten by a bear." It's uncomfortable, it feels far away, and your brain would rather think about literally anything else. So it gets filed under someday. The problem is, someday isn't a date on a calendar. And that 36% of parents with a will isn't 36% of parents who happen to be careless. It's 36% of parents who happen to get around to it before something happened. The other 64% just haven't gotten there yet. And statistically, some of them won't get the chance to. There's also a quieter trap, what I'd call the "my spouse will just figure it out" assumption. A lot of people genuinely believe that if they die, everything automatically and smoothly transfers to their spouse, no paperwork required. And in some narrow situations, certain joint accounts, certain states, that's partially true, but partially true is doing a lot of heavy lifting in that sentence. Add kids from a previous relationship, a retirement account from a job you left a decade ago, a house that's only in one person's name, or simply live in a state with different default rules, and that assumption falls apart fast, and usually nobody discovers it's false until it's too late to fix.
here's a layer almost nobody talks about, and it's not some conspiracy, it's just incentives. The probate system, attorney fees, executor commissions, none of that requires you to have planned anything. It exists and it gets paid whether or not you ever wrote a will. In a lot of states, those fees are calculated as a percentage of the estate's total value, not based on how complicated the actual work is, which means a fairly simple estate, like Big Mike's, can generate almost the same fees as a genuinely complicated one. Nobody's doing anything wrong here. Most attorneys are genuinely trying to help people through an awful process. But notice the structural reality. We'll let probate sort it out later generates billable hours down the road, while let's spend an afternoon on this now doesn't generate anything for anyone except your own family. The system has zero built-in nudge toward prevention, so the nudge has to come from you.
And then there's the stuff that doesn't even show up in probate. The digital and invisible assets. Crypto wallets, online brokerage accounts you opened during a slow week in 2021 and forgot about. Even just the one password manager that holds the keys to everything else. If you're the only person who knows that information exists and how to access it, it doesn't matter how organized your will is. Your family might not even know to look for it. There's research showing that around half of adults don't know where their own parents keep their important documents. And that's the crazy part. It's not that families don't have a plan. Sometimes the plan exists, sitting in a drawer or a folder somewhere, and nobody else on earth knows it's there. Now, I want to actually address the pushback instead of just plowing past it, because some of it is fair. I don't have much, so it doesn't matter. Here's the thing. Big Mike didn't think of himself as someone with an estate. He thought of himself as a guy with a paid-off house and a 401k from a job he barely remembers. But estate isn't a word for rich people. It's just a legal term for everything you own minus everything you owe, added up into one list. That's not mansions and yachts territory. That's just a normal life. If you own a home, have any kind of retirement account, have life insurance through work, or have kids, you already qualify for exactly the situation we've been talking about. The size of the number doesn't change whether probate applies. It just changes how painful that 3 to 7% feels in real dollars. I'm only in my 30s. This is for old people. I get why it feels that way. But car accidents, sudden cardiac events, and fast-moving illnesses don't check your age first. And honestly, the stakes can be higher when you're younger because of that guardianship statistic. If you have minor kids and there's no legal document naming a guardian, a judge you've never met decides who raises your children if both parents are gone, not the grandparent you assumed would step up, not the friend you joked about at your wedding. A judge in a courtroom based on whatever gets presented that day. I'm too young for this, and this matters more because I have kids, are often true at exactly the same time. And then there's the philosophical one. You can't take it with you, so why does it matter what happens after? And honestly, you're right. You can't take it with you, which means it's going somewhere to someone, one way or another. The only real choice is whether you decide where, or whether a percentage-based fee schedule and a court calendar decide for you. None of this requires you to become a different person, or to be obsessed with death, or to assume the worst is coming tomorrow. A person who loves road trips still wears a seatbelt. Loving your family doesn't mean becoming someone else. It just means spending one afternoon making sure that love doesn't get filtered through 14 months of paperwork. Okay, now let's get to the number I think is the actual point of this whole video, the one almost nobody calculates because it's invisible until you go looking for it. Remember that $22,000 Derek's family paid in fees? Don't think of it as $22,000 gone. Think of it as $22,000 that never got to start compounding. If that money had gone directly to Derek and his siblings when their dad passed, and they'd simply parked it in a basic index fund, nothing fancy, just a historical average return around 8% a year, here's what happens. In 10 years, that's roughly $47,500. In 20 years, around $102,000. In 30 years, just over $221,000. That's not $22,000 we lost to paperwork. That's a $221,000 hole in someone's retirement created by a document that was never written. And here's the part that will blow your mind.
that's just the fees. We haven't even touched the $65,000 that went to the wrong person because of one outdated beneficiary form. Run that same 8% for 30 years, and $65,000 becomes roughly $654,000. $654,000 from a form. That takes 10 minutes to update. Combine both numbers, and one piece of unfinished paperwork created an $875,000 difference 30 years down the line for people who are statistically very likely to need every bit of that for their own retirement.
Now, flip it around to Priya and Jordan. That's $650 they spent. If you wanted to get really technical, you could even calculate its opportunity cost. At 8% for 30 years, $650 becomes about $6,500. So, worst case, doing it right cost them roughly $6,500 in future value. Best case, doing it wrong cost Derek's family $875,000 in future value, plus over a year of stress, plus carrying costs on an empty house, plus grief made heavier by paperwork. That's not a close call. That's not even the same conversation. The math is brutal. And notice it's brutal in exactly one direction, and it's not the direction most people instinctively assume. This is also, by the way, where generational wealth quietly gets built or quietly gets erased. The families that build something lasting across generations usually aren't the families that earned the most money. They're the families where money transferred efficiently, where the next generation got their inheritance at 35 instead of 37 and got 2 extra years to let it grow, instead of 2 extra years going toward a law firm's billing department. So here's where I want to land all of this. This video was never really about death. It's about the fact that the people you love most are going to have one of the hardest weeks of their lives at some point. And right now, today, while none of this feels urgent, you have a say in whether that week also turns into the hardest year of their financial lives. The difference between a family that grieves and slowly moves forward and a family that grieves while fighting a court process for 14 months almost never comes down to how much money was involved. It comes down to whether one afternoon at some point finally got spent on paperwork. The difference between a family that's protected and a family that's exposed is almost never about how much they had. It's just one updated form, one honest conversation, one afternoon that finally happened instead of getting pushed to someday again. You become the kind of person who thinks 2 steps ahead, not out of fear, but because you've actually run the numbers, and the numbers only ever point one way. An hour with an estate attorney, or even an evening with a legitimate online service, isn't really an expense. It might be the highest return financial decision most people will ever make and never get to see. Because the return doesn't land in your account, it lands in your family's life, on a day you won't be there for. If this gave you a different way of thinking about something you've probably been putting off, this week might be a good time to actually do something about it. Not because something bad is about to happen, but because eventually something always does, to all of us. And the only real choice is whether you decided what happens next or left it up to a formula. And quick honest reminder, I'm not a lawyer or a financial advisor, and the laws around wills, probate, and beneficiaries vary a lot by state, so please talk to a licensed estate planning attorney about your specific situation. This video is just here to get you thinking about it in the first place. If this kind of breakdown is useful to you, subscribe so you don't miss the next one. Drop a like if you made it this far, and let me know in the comments. Did you already have this handled, or is this the nudge you needed? See you in the next one.